Picture this for a moment. You're reading the news, maybe over your morning coffee, and you come across a story about someone your age who retired early. Comfortable. No financial stress. And they did it through disciplined long-term investing in the stock market. And you think to yourself, I've been meaning to do that for years. So you pull up a brokerage website. You see terms like P/E ratio, market capitalization, dividend yield, bull market, bear market, and suddenly that simple idea feels impossibly complicated, so you close the tab. And tell yourself you'll come back to it when you understand it better. Here's the hard truth. That day may never come, not because investing is beyond your reach, but because the financial industry has never had a real incentive to make it simple. That changes right now. I'm Felix, and this channel exists for one reason: to give people over 50 the straightforward, no-nonsense financial knowledge that schools never taught and Wall Street never volunteered. If you've spent decades working hard, raising a family, and building a life, and you're now wondering whether your money is working as hard as you have, this video is for you. Make sure you subscribe, and give this a thumbs up if it's helpful. It tells me you want more content like this. Section 1. What is a stock? Let's start at the very beginning, because this is where most financial education fails people. Stock is ownership in a company. That's it. When you purchase one share of a company like Johnson & Johnson, you are legally a part owner of that business, however small that ownership may be. Now, ownership in a company gives you two ways to potentially grow your money. Way number 1, capital appreciation. This simply means the value of your shares increases over time. If you purchase a share for $80 and its value grows to $120, you have made a $40 profit per share. No complexity. No mystery. Way number 2, dividends. Some companies distribute a portion of their profits directly to shareholders on a regular basis, usually quarterly. These payments are called dividends. Many mature, well-established American companies have paid reliable dividends for decades. For anyone living on a fixed or semi-fixed income, this can be a meaningful and predictable income stream. The key mental shift here: when you own stock, you are not gambling. You are placing a measured, informed bet that a business will be worth more in the future than it is today. That is a fundamentally different mindset, and it's the difference between investors who build lasting wealth and those who treat the market like a casino. Section 2. Shares, market cap, and valuation. What is a share? A share is simply the unit of stock. If a company has issued 10 million shares total and you own 1,000 of them, you own 1/10 of 1% of that company. Here is something that trips up beginners and even some experienced investors. The price per share alone means nothing. Consider two companies. Both are valued at $1 billion in total. Company A has issued 10 million shares, so each share costs $100. Company B has issued 100 million shares, so each share costs $10. A beginner sees the $10 stock and assumes it's the better deal. It is not. What matters is the total value of the company and what you are receiving in return for your investment. Market capitalization. This is the single most important concept for a new investor to internalize. Market capitalization, or market cap, is the total value of all of a company's shares combined. You calculate it simply: share price multiplied by total shares outstanding. Companies are generally grouped by market cap. Small cap, roughly $300 million to $2 billion. Higher risk, but more room to grow. Mid cap, roughly $2 billion to $10 billion. A balance of growth potential and stability. Large cap, over $10 billion. Established companies with more predictable performance. Mega cap, over $1 trillion. Companies like Apple, Microsoft, and Alphabet. These are household names with global reach. For investors over 50, large cap and mega cap companies often represent a more appropriate starting point. They tend to be more stable, more transparent, and many pay regular dividends. Section 3. How stock prices move. This is what most people genuinely want to understand, and it's simpler than the financial media would have you believe. Stock prices move based on supply and demand. When more investors want to buy a stock than sell it, the price rises. When more want to sell than buy, the price falls. But what drives those buying and selling decisions? Sometimes it is entirely rational. A company reports stronger earnings than analysts predicted, so investors conclude the company is worth more and purchase shares accordingly. Sometimes it is emotional. Fear, speculation, or media-driven panic sends prices swinging with no real change in the underlying business. Trading versus investing. Know the difference. Trading is short-term activity. Traders attempt to profit from daily or weekly price movements. This requires predicting human psychology, market timing, and a tolerance for significant risk. Research consistently shows that most active traders underperform a simple index fund over time. Investing is long-term ownership. Investors buy shares in businesses they believe will be worth substantially more in 10, 15, or 20 years, and they hold through the inevitable market fluctuations without panic. According to research from Dalbar, the average equity investor earned 5.5% per year over a 20-year period, while the broader S&P 500 returned 7.2% annually over that same period. That 1.7% gap is not caused by bad stock picks. It is caused by emotional decision-making, selling during downturns and chasing gains during rallies. Section 4. Understanding valuation metrics. The price-to-earnings ratio, P/E. The P/E ratio tells you how much investors are currently paying for each dollar of a company's annual earnings. If a company's stock trades at $60 per share and earns $3 per share annually, the P/E ratio is 20. You are paying $20 for every $1 of annual profit. A low P/E ratio is not automatically a bargain. It may indicate that the market expects the company's earnings to decline. A high P/E ratio is not automatically overpriced. It may indicate that investors expect rapid future growth. Context is everything. A P/E ratio only becomes meaningful when compared to the industry average, the company's own historical P/E, and its growth trajectory. Earnings per share, EPS is straightforward. A company's total annual profit divided by the number of shares outstanding. If a company earns $50 million in profit and has 25 million shares, the EPS is $2. Companies report this figure every quarter. When a company's EPS exceeds analyst expectations, the stock typically rises, even if the underlying performance was modest. The market does not trade on reality alone. It trades on expectations relative to reality. Section 5. Dividends and Buybacks. Dividends. Income from ownership. A dividend is a cash payment made by a company to its shareholders, typically 4 times per year. If you own 200 shares of a company paying $2 per share annually, you receive $400 per year simply for owning those shares. For investors over 50, particularly those approaching or in retirement, dividend-paying stocks can provide regular income without requiring you to sell your holdings. However, exercise caution when evaluating dividend yields. The dividend yield is the annual dividend divided by the stock price. When a stock's price drops sharply, the yield appears to rise, and that high yield may look attractive. But a falling stock price often signals a company in financial difficulty that may soon reduce or eliminate its dividend entirely. Stock buybacks. A buyback occurs when a company uses its cash reserves to purchase its own shares from the open market, reducing the total number of shares outstanding. This increases the ownership percentage of remaining shareholders and generally supports the stock price. Buybacks are an alternative way for companies to return value to shareholders. Unlike dividends, buybacks are not taxed as ordinary income at the time they occur, making them, in certain situations, a more tax-efficient form of shareholder return. Section 6. Bull and bear markets. You will hear these terms constantly, so let's define them clearly. A bull market is a sustained period of rising stock prices, generally defined as a 20% gain from recent lows. Since 1950, the average bull market has lasted approximately 4.5 years, with average gains exceeding 150%. A bear market is the opposite, a sustained decline of 20% or more from recent highs. The average bear market has historically lasted less than 10 months, with an average loss of around 32%. The psychological challenge of bear markets is well documented. Losses feel disproportionately painful compared to equivalent gains. This is called loss aversion, and it causes investors to sell at exactly the wrong time. According to data from Charles Schwab, investors who stayed fully invested through the 2008 financial crisis and its recovery earned approximately 8% per year through 2018. Investors who sold during the crisis and remained in cash earned essentially nothing. Section 7. Practical order to YPES. When you are ready to purchase stocks, you will encounter different types of orders. Here are the ones that matter most. Market order. You instruct your broker to purchase the stock immediately at whatever the current price is. Fast and simple, but you have no control over the exact price you pay. Limit order. You specify the maximum price you are willing to pay. Your order will only execute if the stock reaches that price or lower. This gives you price control, though there is no guarantee the order will be filled. Stop loss order. You set a price below your purchase price. If the stock declines to that level, it sells automatically, limiting your potential loss. This sounds prudent in theory. In practice, a temporary market dip can trigger your stop loss, causing you to sell at a loss right before the price recovers. Use these carefully. The bid-ask spread. The bid price is the highest a buyer will currently pay. The ask price is the lowest a seller will currently accept. The difference between them is the spread. When you buy, you pay the ask. When you sell, you receive the bid. For large, well-traded companies, this spread is negligible. For smaller, less traded stocks, it can be significant. Section 8. Index funds and the case for SIMPLICITY. This is arguably the most important section of this entire video. An index fund is an investment fund designed to replicate the performance of a specific market index, such as the S&P 500, which represents the 500 largest publicly traded companies in the United States. When you invest in an S&P 500 index fund, you are buying small ownership stakes in all 500 of those companies simultaneously. You achieve instant diversification across the largest, most established American businesses, with a single investment and minimal fees. Consider this. Over a 15-year period ending in 2020, nearly 90% of actively managed large-cap mutual funds run by professional stock pickers, failed to outperform the S&P 500. And those managers typically charge 1% or more per year in fees for that underperformance. A basic S&P 500 index fund often charges less than 0.1% annually. Warren Buffett, widely considered one of the greatest investors in history, has stated publicly that for most people, the right strategy is a low-cost S&P 500 index fund, held consistently over time. He has instructed that 90% of his wife's inheritance be invested in exactly that. The true cost of fees. This is where investors quietly lose enormous sums of money without realizing it. Consider a $10,000 investment earning 7% annually over 30 years. With a 0.1% annual fee, you end up with approximately $72,300. With a 1% annual fee, common in actively managed funds, you end up with roughly $57,400. That is nearly $15,000 lost to fees on a single $10,000 investment. Scale that across a larger portfolio held over a lifetime, and the difference reaches hundreds of thousands of dollars. Section 9. Diversification and asset. Untrue diversification. Owning 10 different technology stocks is not diversification. If the technology sector declines, all 10 positions decline together. Genuine diversification means spreading your investments across multiple sectors: technology, healthcare, financials, consumer staples, energy, utilities, as well as across different geographies and asset classes. Bonds are loans you extend to corporations or governments in exchange for regular interest payments and the return of your principal at a specified date. Bonds are generally less volatile than stocks and serve as a stabilizing component in a balanced portfolio. Conventional wisdom suggests that investors approaching retirement should increase their bond allocation, not because bonds produce superior returns, but because they reduce volatility at a time when you can least afford a significant loss. Asset allocation. This is the most consequential investment decision most people will ever make, and most people never make it deliberately. Research from Brinson, Hood, and Bauer found that more than 90% of a portfolio's long-term performance comes from how the portfolio is allocated between asset classes, not from which specific stocks were selected or when trades were made. If you are in your early 50s and in good health, you may have 30 or more years of investment horizon. A portfolio of 70 to 80% stocks and 20 to 30% bonds may be entirely appropriate. As you move through your 60s and into retirement, gradually shifting toward a more conservative allocation becomes prudent. Section 10. Strategies that work dollar cost averaging. This strategy involves investing a fixed amount of money at regular intervals, say $300 every month, regardless of whether the market is rising or falling. When prices are high, your $300 buys fewer shares. When prices are lower, it buys more. Over time, you naturally accumulate more shares at lower prices and fewer at higher prices, without any attempt to predict market movements. More importantly, this strategy removes emotion from the equation. You invest automatically, consistently, and without the temptation to wait for a better moment. In investing, the best moment is almost always earlier than feels comfortable. The power of compounding. Albert Einstein reportedly called compound interest the eighth wonder of the world. Whether or not he said it, the mathematics are extraordinary. Compound growth means you earn returns not only on your original investment, but on the returns you have already accumulated. Each year, your base grows larger, and your gains grow with it. Consider two investors. The first invests $5,000 per year from age 25 to 35, a total of $50,000, then never invests another dollar. The second begins at 35 and invests $5,000 per year until age 65, a total of $150,000. Assuming 7% annual returns, the first investor arrives at 65 with more money, despite having invested one-third as much, simply because of the 10 additional years of compounding. For investors starting at 50, this principle still applies with meaningful force. You may have 15, 20, or even 25 years of growth ahead of you. Time remains your most valuable asset. Section 11. Taxes and smart land. One of the most overlooked advantages available to long-term investors is the tax treatment of capital gains, short-term capital gains. Profits from investments held less than 1 year are taxed as ordinary income, which can reach 37% in the highest bracket. Long-term capital gains. Profits from investments held more than 1 year are taxed at significantly lower rates, 0%, 15%, or 20%, depending on your income level. A $10,000 profit, the difference between short-term and long-term tax treatment can amount to $900 or more in additional taxes. Holding your investments for at least 1 year before selling is not just financially sound, it is also considerably more tax efficient. Additionally, if you are investing through a tax-advantaged account such as a traditional IRA or a Roth IRA, your investments may grow tax-deferred or even tax-free. This is another layer of advantage that disciplined long-term investors use to their benefit. Section 12. What to look at and what to ignore. Fundamental analysis. This is the evaluation of a company based on its actual business. Revenue growth, profit margins, competitive position, management quality, balance sheet strength, and industry trends. This is what long-term serious investors focus on. If you own stock in a company and have never read their annual report, called a 10K, you do not yet fully know what you own. What to ignore. Financial media is engineered to capture your attention. Alarmist headlines about market crashes, breathless coverage of hot stocks, and predictions of inevitable downturns. All of it is optimized for engagement, not for your financial well-being. Turn it off. Check your portfolio no more than once per quarter. Resist the urge to react to every headline. Study by Fidelity found that the best-performing investor accounts in their database shared two characteristics. The investors had either forgotten they had the accounts, or they were deceased. The accounts that sat untouched year after year consistently outperformed those that were actively managed. Section 13. Glossary at a glance. Here are a few remaining terms worth knowing. Blue chip stocks. Shares of large, financially stable, well-established companies, such as Coca-Cola, Procter & Gamble, or Johnson & Johnson. Generally considered more conservative investments. Growth stocks. Companies expected to grow earnings faster than average. They typically reinvest profits rather than paying dividends. Higher potential return, higher risk. Value stocks. Companies trading below what analysts believe they are worth based on their fundamentals. Often pay dividends. The bet is that the market will eventually recognize their true value. Expense ratio. The annual fee charged by a mutual fund or ETF, expressed as a percentage of your investment. Index funds often charge below 0.1%. Actively managed funds may charge 1% or more. Rebalancing. Periodically adjusting your portfolio back to your target allocation. If stocks have grown to represent a larger portion of your portfolio than intended, rebalancing means selling some stocks and buying more bonds, effectively selling high and buying low. 52-week high/low. The highest and lowest price a stock has traded at over the past year. Useful as context, but not a buy or sell signal on its own. Insider trading. Illegal buying or selling of stock based on material, non-public information. However, executives can legally trade their own company's stock. They simply must report it publicly. Monitoring legal insider activity can offer useful signal. The only question that RetirementPlanning now understand more about the stock market than the vast majority of Americans. You understand what stocks are, how prices move, why index funds outperform most professionals, why fees matter more than most people realize, and why time, even now at this stage of life, remains your most powerful financial asset. The stock market is not a tool reserved for the young or the wealthy. It is one of the most reliable wealth-building mechanisms available to ordinary people, but only for those who actually use it. Every person you know who has achieved genuine financial security through investing started exactly where you are right now, informed enough to begin, and willing to take that first step despite the uncertainty. The only question left is whether you will take action with this information, or file it away as interesting knowledge that never changes your financial reality. Open a brokerage account this week. Fidelity, Vanguard, and Charles Schwab are all reputable, established institutions with no commission on standard stock trades. Start with a total market or S&P 500 index fund. Set up an automatic monthly contribution, whatever amount is realistic for you right now. Then increase it over time as your confidence and capacity grow. And come back here, because next time we're going to go deeper into how to evaluate whether a company is actually worth owning, and how to build a portfolio designed specifically for long-term stability and income. I'll see you in the next video.